taxes in Kenya are administered by KRA, or what we call Kenya Revenue Authority, which is a body that was established in 1995 through an act of parliament. So it's the organization that is mandated to collect revenue on behalf of the government, as well as now follow up and ensure that tax laws and provisions are adhered to. So this is an entity that will always be on your neck when you don't comply to taxes or when you don't meet your tax obligations. Broadly, there are two major categories of taxes. We have the direct and the indirect taxes. So these are the two major segments or categories of tax regime in Kenya. And for direct tax, when you talk of direct tax, we say it's a type of tax for which taxpayer pay directly to the government. So this is dependent on your level of income, and the person upon whom it is imposed is the one required to pay the same to the government directly. But when we talk of indirect tax, on the other hand, this is a type of tax that is passed or shifted to another person. And a very good example for indirect tax is what we call VAT. Because for VAT, especially for businesses, this is a tax that you collect on behalf of the government. So you might be the one raising the ATR, you might be the one raising the invoice and collecting the money, but that portion of tax or that portion of VAT, you collect it on behalf of the government. So that is a very good example of an indirect tax. We're gonna be looking at a few definition of terms. These are terms that perhaps you've heard in the media, your auditors have also mentioned. So we're gonna be looking at what each of them mean. And we can start with the tax period, which is also a very common term, especially when we are talking about the Finance Act and the CS is even reading the budget. So when we talk about tax period, for corporate tax purposes, this refers to the 12-month period within which you are supposed to recognize your income, compute profitability, and pay taxes on the same. So it can be between January to December for most companies as it is, but it can be even any other period as you might deem it fit. And it can be June to May, it could be July to June. It just depends on how you want it to be. And of course, you can always change this. You can always say that it's a bit hectic when you're doing Jan to December like everybody else, and you can move it to, let's say, April to March. So of course, we know that once the financial year ends, you have 6 months to do what we call a self-assessment return, which is due annually. So for taxpayers or for companies whose tax period is between January and December, then you're required to do so within the 6 months. So that means by 30th of June, you should have finalized working on your books and remitted an income tax return. Of course, for installment taxes, the tax period is usually 4th, 6th, 9th, and 12th month for the company's next financial period. So this is when installment taxes are due. And so if I can use the most common example again, for companies with January to December accounting period, then installment taxes will be due on April 20th, on 6th 20th, or rather the June 20th, on September 20th, as well as the last installment being due 20th of December. For other tax heads, such as VAT, withholding tax, residential rental income, and most recently digital service tax, these are due on a monthly basis. Especially for VAT, withholding tax and all that, they are due by 20th of each month. So if someone was to ask you what is the tax period for VAT, then you have to recognize that on a monthly basis. For PS1, the same, only that this is due by 9th of the following month. So it's still, when you're talking about payee, you're still going to consider the tax period to be the month preceding that. And of course for VAT the same, because these are taxes that are recognized on a monthly basis. We have what we call the tax procedures. The tax procedures are a uniform set of rules and procedures which were effected by the Tax Procedures Act, and the main aim was to facilitate tax compliance and encourage effective and efficient collection of tax. So these were processes that the government attempted to make uniform so that when we are talking about tax administration, you know that if I'm late to file my taxes, this is going to be the penalty. Yeah, if I'm late again to make the payment, this will be the interest computed per month. If I have an assessment from KRA, this is how I'll go about objecting to the same. So all those processes and procedures were contained in the Tax Procedures Act, which came into force in the year 2016. And as I said, the aim was to provide uniform procedures for consistent and efficient administration of the tax laws in Kenya, with the goal being to facilitate tax compliance and encourage effective and efficient collection of tax. The Tax Appeals Tribunal, also I know it's a term that we have always had, and this refers to an institution that was established in 2015, and the goal was to ensure that there is a single tribunal that will be hearing appeals. Yeah, you know, sometimes the commissioner comes along and issues an assessment and proceeds to confirm it as the right assessment according to him. And sometimes, as a taxpayer, you wonder now, what do you do? Yeah, so in 2015, this institution was put in place as a mechanism for taxpayers to escalate tax disputes. If you are aggrieved by a decision or by an assessment by KRA, then you have that right to escalate the dispute to this, what you're calling Tax Appeals Tribunal. And the Tax Appeals Tribunal came to replace some committees used to call local committee, which used to hear corporate tax matters or income tax matters, and also replaced the VAT Tribunal, which used to hear all disputes relating to VAT. So it's more of a court, yes, but more friendly version of a court, in that the members or the people who sit in that tribunal are professionals. They're not really judges or magistrates. They are simply lawyers who have met certain requirements. We also have accountants and other members who are respected in the society. So they have that ability to really look at matters fairly, of course adhering to the law, but a bit flexible as compared to a magistrate court or the high court. When you talk over tax audit, which is also a very common term when we are talking about taxes, a tax audit is simply the process, is simply that exercise that KRA undertakes to examine your books, to investigate, to evaluate and review your accounting records for them to establish whether you've been compliant with taxes or you have been underpaying taxes. Remember, in Kenya we run what we call a self-assessment regime, whereby as taxpayers, as business people, you're given that chance or that opportunity to compute your own taxes according to your best judgment. But of course, at some point, KRA will want to come and say, yes, you have been filing your taxes for the last 5 years, but have you been doing the right thing? Have you been adhering to all the rules? And for them now to establish whether you have been doing that, they will carry out what we call a tax audit. So it's simply a process for KRA to verify your self-assessment returns, to establish whether you are compliant fully or if you've been undercutting or underpaying taxes and denying the government its fair share of the revenue. The taxman can go back all the way the last 5 years from the year of the last assessment. So it means that now we're in 2021, KRA can only go back for the last 5 years to establish or to ascertain to what extent have you been complying or non-complying. However, there is also a chance that if you have not been complying or you've been doing what we call tax evasion, which is a criminal offense for that matter, then the law gives KRA the mandate or the freedom to go back as many years back as possible without necessarily looking at the 5 years. According to our experience, what has been really driving KRA to conduct audits on certain companies and not others is where, number one, they detect non-compliance, and they can detect non-compliance using their systems. Like for instance, you can find a company has issued an invoice to a client, and the company has decided, you know what, we are not going to declare VAT on that invoice, and we're not going to file. But the person who got the invoice goes ahead and claims that invoice. So of course now when the system is run, iTax being an intelligent system will be able to detect that there is an invoice that somebody has claimed, but the person who actually sold the goods has not declared. Sometimes KRA audit can also be triggered by an application for refund, because we found many times you can find yourself that you have paid over taxes, or you have overpaid your taxes. You can overpay your income taxes, you can overpay your VAT, and sometimes you want the money back. So, of course, KRA being KRA, and the country being the way it is, before they refund you the money, they want to make sure that you also don't owe them any other amount in terms of misdeclarations and under assessment on your transactions. The other thing that can trigger an audit is industry trends. Sometimes you find that certain industries are targeted at any given time. Last year we had a trend whereby alcoholic manufacturers were really targeted by KRA, and of course there were a lot of issues in terms of fake stamps and the spirit being illegal and all that. So we saw a lot of alcoholic manufacturers being audited last year due to the fact that that particular industry had certain issues, it had certain trends that KRA deemed to have necessitated an audit. Also, KRA can obtain information from related company audits, whereby company A that is related to B is audited, and they realize that company A is so non-compliant. And of course, the companies being related, and of course the management or maybe the leadership being the same, KRA will be of the opinion that if you have not complied in company A, then it's likely that you've also not complied in company B. At this point, I want us to look at the rights and obligations of taxpayers. It's good to know, before you even go to the nitty-gritties, it's good to know your rights as a taxpayer. And of course, you know where there's a right, there's also an obligation. The first right you have as a taxpayer is that right to be issued with a PIN. So this is what we call the personal identification number, which everybody must have, and especially when you're transacting as a business, as an individual. Most of the services that you'll need from the government or even in the private sector, you'll certainly need a PIN. So it's your right as a taxpayer to be granted a PIN certificate by KRA so that you can be able to do your transactions. Then you also have a right to confidentiality and privacy. So if KRA obtains your data, they have that obligation to you as a taxpayer to ensure that there is maximum confidentiality and there is privacy in that they will not unnecessarily disclose your affairs to the public unless there is a legal duty to do so. Then you also have a right to apply for waiver of penalty and interest. Sometimes when you have been late in paying your taxes, or you have found yourself in a situation whereby you have been able to file your returns on time and there is a penalty imposed, then you have that right to apply for waiver of such penalty and the interest that has accrued. And then KRA, based on the merit, they can consider and either grant or reject based on the merit of each case. You also have a right to apply for a write-off of a debt. So sometimes you might find maybe you have interacted, or rather you've transacted with a company, and that company ends up going under or being liquidated. And perhaps you had filed your taxes based on your transactions with such a company, which now resorts to a debt. So you have the right now to write to KRA and tell them that in all honesty, you need to have the debt written off because the entity that resorted, or that the transaction that you had carried out that led to that debt, you're no longer able to collect from such an institution. And of course, based on the merit, KRA can either grant the request or they can deny it based on the circumstances. You also have a right to be refunded any overpaid taxes, especially when you overpay within a period of 5 years. You can always apply to KRA and tell them that you miscalculated and ended up paying more than you should. So it's your right to apply for a refund for that tax to be refunded. And of course, we know for VAT, usually KRA has given about 90 days as the time for processing these refunds. But of course, even the 90 days is what the law talks about, but in actual sense, the period ends up being more than the 90 days. But as a taxpayer, you should know that it's your right to be refunded this within such a period. Then you have the right to object to a tax decision, so whereby KRA makes an assessment and tells you need to pay X amount in terms of taxes, and you are of a different opinion, then you have a right to object to that decision. Of course, you need to really state your grounds for objection, and you'll also need to really document and show evidence as to why you think the position is different. Then you also have a right to appeal to a tax objection, a decision, that is to the Tax Appeals Tribunal. When you are sort of aggrieved by a tax decision by KRA, and you have already objectioned, or rather given your objection, and KRA proceeds to confirm that assessment, then you have the right to take that decision to the Tax Appeals Tribunal. And even if the Tax Appeals Tribunal does not agree with you, you still have that right to escalate it further to the High Court. And in a worst case scenario where the High Court again does not give you relief, you can appeal the decision to the Court of Appeal. However, in each of those institutions, you have the right to ask for an alternative dispute resolution, and mostly this involves whereby you tell KRA, let's go out of court and try to settle this matter amicably, not necessarily through litigation. As I said, where there's a right, there's also an obligation. So, of course, the first obligation you have as a taxpayer is to appear before the commissioner, where the commissioner is satisfied that you have committed an offense. So, the law allows the commissioner to write to you and request you to appear before him so that you can answer, or rather you can give clarity on certain offenses that he could think you have committed. You also have an obligation to produce records for purposes of audit. So, as I said, KRA is generally mandated to review records for the last 5 years. So if they write to you and they say they want to carry out a review, then you have an obligation to produce those records so that the commissioner can review them. Then you also have an obligation to notify the commissioner in case there are any changes in terms of your place of business, your trading name, your registered address, or any other material information that you'll feel it's important. So you have that duty to let KRA know that you're no longer operating in a certain office, you have now moved to a different office. Or maybe you have changed all your email addresses and postal addresses, because the commissioner or the taxman will need to keep communicating to you from time to time. So they will need the correct and accurate details of your address for them to do so. So it's your duty to ensure that any changes with respect to your place of business, trading name, registered address, and any other material changes in your business, you need to notify them because it's your legal duty to do so. Then you also have a duty to repay any amount erroneously refunded upon demand by the commissioner. So of course we said you can find yourself that you have overpaid taxes and you have applied for a refund. And of course, given the fact that all these processes are handled by humans, there is also a chance that KRA might refund you more than they should actually do. And of course, we are saying it's an obligation for you now to repay any such amount that is refunded to you erroneously to the commissioner. So it's your duty to do so. And then lastly, you have a duty to submit a tax return under any tax law that is there in the country. And this return, you have to do it in the approved form and in the manner that the commissioner requires. So if a commissioner says, now we are moving from manual, we'll have to file all our returns through the system, then it's your legal duty, it's your obligation to ensure that you have complied to that and you've remitted the returns in that approved format and in the manner that the commissioner requires. Let's also briefly look at general tax principles, very briefly. Tax principles are the rules or the sets of guidelines that guide tax policy formulation in the country. So these are the guidelines that the government has to adhere to when formulating tax policy, so that if those policies are being enacted, then they have to be in compliance to these general tax principles. And of course, these principles are also global. You find these are a set of globally accepted principles so that if any country is talking about making any tax changes, they have to really make consideration for these principles, because we say the world now is a global village. You cannot afford to have your own set of policies that are so different from what the global community deems to be the best practice. So the first principle is efficiency, and of course this deals with the cost of administration for taxes, that is to the business, or rather to the taxpayers, and as well as to the government. So it says that any tax policy or any tax regulation should be very efficient, in that the compliance costs to the business or to the taxpayers, and also to that of the government, should be as minimal as possible. The second principle is flexibility, and for flexibility, true to its word, the policies need to be very dynamic, in that they should be able to change with the changes in the economy. We should not have a period, or we should not have an instance whereby we have a policy that is so rigid that is not able to adhere to changes in the economy. Like right now, we are really talking about digital revolution. So it only makes sense, and it's only a good sort of principle, or rather a good practice, to ensure that the tax policies as we have them today are also recognizing the fact that we are in a digital revolution, and recognize that we are no longer dealing with brick and mortar enterprises. There are also a lot of online businesses, and therefore changes should be made to the tax policies so that it can be aligned to those changes. Then the third principle is neutrality, and of course when we say a tax principle needs to be neutral, we are simply saying that it should refrain from interfering with the market's allocation of resources, that is economic resources. It should not bring any bias, or it should not be seen to discriminate against a certain industry, and it should also not deal, or rather interfere with the market forces. The market forces of demand and supply should not really be affected by tax principle. The fourth is effectiveness and fairness. So each policy should be able to generate the right amount of taxes at any given time, while avoiding instances of double taxation or unintentional non-taxation. So we should not have a tax policy that ensures that certain people are not paying taxes while others are paying more than they should. So we should have an element of fairness and effectiveness in the policy regulation, so that we don't have double taxation, and we also don't have people not paying taxes where others are actually overpaying. We also have equity. When you talk of equity, it's quite an extension of the word fairness. And for tax purposes, we normally have two sets of definitions for equity. It can be horizontal equity. And under horizontal equity, we are saying that two people who are in the same economic sort of position, or people who are of the same financial position, should almost pay the same amount of tax, because in terms of status and economic status, these two people are the same. So for a tax policy to be adherent to equity, or to this principle of equity, it needs to ensure that those two people, no matter their industries, no matter what they do for a living, they should actually pay the same amount of tax, or just about the same amount of tax. Then we also have vertical equity. And under vertical equity, we are saying that if we have two people under different levels of income, then their tax should not be the same. So you might look at it as an opposite of horizontal equity, but this is basically now trying to look at two different people who have different levels of income, who have different economic position. They should not be deemed, or they should not be required to remit taxes the same, because they are very different in terms of the economic status. So that's what we refer to as equity. Then most important is ease of collection and ease of compliance. And this also tends to really be closely related to efficiency, the efficiency we talked about. And this ensures that, or rather it states that a policy should enable the government get the most possible revenue at the least possible cost. And also we say that it must require people to be able to calculate your tax bills fairly and easily. And of course, we have seen some of the tax changes that have been meant to adhere to this principle. A very good example being the turnover tax for people with a turnover between 1 million and 50 million, which we're going to be looking at later on. And these are said that you just calculate 1% of your revenue and pay taxes. And you know, when you talk of 1% of revenue, you're able to quickly calculate that. The other one is the 10% rental income for landlords. And of course, it says that you take whatever you're taking from your tenants, then just pay 10%. And of course, you find that anybody can be able now to calculate that. So I think the reasoning behind that formulation, or the formulation of that particular policy, was to ensure that there is a lot of ease in terms of compliance, and also the government will also not really spend so much time trying to collect. So those are the principles of taxation. As we finish on that, we have the last part, which is certainty and simplicity, which also tends to really borrow so much from the previous one. And under this, we say that rules should be very clear and simple to understand, so that you as a taxpayer, you really are able to know your position, you're able to know your obligation, and you really need to know what you need to do so that you can comply to any tax regulation. So I think that's a bit about principles. I want us to now go to the Kenyan tax system because I think this is now the gist of the matter. And under this, we'll be looking at different taxes. We'll be looking at PS1, we'll be looking at income tax, or what we call corporate tax. We'll be looking at value-added tax and withholding taxes, as well as other forms of taxes. And what is very important for you to note is that the Kenyan tax system is not governed by one single regulation, but rather a combination of various tax acts and regulations, including legal notices, so which combine and together, when read together, they now form what we call the Kenyan tax system. Some of these taxes, or rather some of these acts, include the Income Tax Act. We have the VAT Act, Tax Procedures Act, which we discussed earlier. We also have Excess Duty Act. We have Tax Appeals Tribunal Act. We also have what we call the East African Customs Management Act, which normally deals with imports. So these are the laws or regulations that govern the whole tax system here in the Republic of Kenya. And we're going to be looking at each of these and what they mean to each business. So as we said earlier, the whole Kenyan tax regime, or the tax system, is broadly divided into two. And we saw that it's divided into direct taxes and indirect taxes. So this is, in a nutshell, you can say that if you are to present the Kenyan tax system in an image, then what we are displaying in your screen today is what that image will look like. Because we have, on one side, we have the direct taxes, and these basically mean all forms of income taxes, including PS1, withholding tax, income tax, capital gains tax, rental income tax. They all fall under this left side of direct taxes. And then on the other side, we have indirect taxes, which is basically VAT, customs, excess duties, and any other indirect taxes that are there. So let's start by looking at the direct taxes. As we said, these are paid by individuals or institutions directly to an imposing entity. Like for instance, if we talk of income tax or corporate tax, this is due on your profit. So when you make a profit, then you have to pay that directly to an imposing entity. And in this case, and as we also mentioned earlier, the imposing entity in Kenya, the body that is mandated legally to impose taxes in Kenya is KRA. So that is what we mean by direct taxes. And of course, we can start by looking at some of these direct taxes, starting with PS1. PS1 is another form of income tax and also a form of direct tax, which is payable on employment income. So some countries, they call these employment taxes, but here in Kenya, we normally talk of PS1. And it's basically what you pay on your salaries. I know for the people who are in our payroll, whether you're a director or an employee, when you look at your pay slip, you always see this amount. Sometimes it's not a very good thing to see because if given a chance, I know most of us will not want to, or rather want the salary to be deducted anything. Yeah, you better be given as it is in your employment contract. But of course, we do understand that employers are under a legal duty to ensure that they deduct PS1 on your salaries, on your wages, when you're given any leave allowances, when you're paid for being sick, any commissions payable to you, when you perform well and you're paid a bonus, again, taxes must be deducted on that. When you're being paid gratuity or service pay, if you have any car benefits, housing benefits, any telephone allowances and overtime allowances, all these categories of incomes are actually subject to pay-as-you-earn. So in fact, when you look at the pay-as-you-earn regulations, you find that it's almost anything that you can earn from your employer will almost certainly be subject to tax, other than just a few things like the medical benefits and the pension, and some few other areas thereabout. But basically anything else that you earn from your employer, you'll have to be deducted pay-as-you-earn. Of course, a very important point for you to note is that as a resident taxpayer, all your worldwide income is actually taxable here in the country. So assuming you are a Kenyan taxpayer, duly resident here, but from time to time you rush to Uganda, you rush to Rwanda, you rush to Europe, and you make some income. The law requires that all that worldwide income should actually be taxed here locally. But of course, it also depends if that other country that you're earning the income, if you have a double taxation agreement, then you can be able to get a credit for any taxes that have been paid outside there. So it's good to know that the worldwide income that you earn as a taxpayer, all of it needs to be subjected to taxation here in Kenya because that's what the law requires. Then for non-residents, it's a bit easy because we only say that any income they have derived from Kenya is what needs to be subjected to taxes here. So any other income they earn from their home countries, KRA or the Kenyan government will not be so much concerned about it because we only focused on what is it that these people are generating from Kenya. Of course, according to the Tax Procedures Act, pay should be filed and remitted by 9th of every month. So it's common knowledge that the due date for pay is 9th. But also, it's good for employees to note that at the end of the year, even if your pay-as-you-earn has been deducted from your salary, then you're also under a duty to remit what we call an income tax return, which is due by 30th of June. So unlike companies, for all individuals, the financial year is the same. So it means that for all individuals, your financial year must be between January and December. For companies, we said a company can decide to be different. It can be April to March, but for individuals, the financial period or the financial year for income tax purposes has to be between Jan and December, and therefore that makes 30th of June to be the deadline for you to remit the income tax return. PS1 rates, normally PS1 is deducted on a graduated scale between 10% and 30%. And currently the rates that are in place says that the first 24,000 is actually, if somebody earns under 24,000, that income is actually exempt from taxation. But if you earn, let's say 50,000, the first 24,000 will be subject to tax at 10%. And then the next 8,333 will be subject to tax at 25%, sorry. And then any income above that 2,333 then will be subject to tax at a flat rate of 30%. And this notwithstanding, as a resident taxpayer, you'll also be allowed a relief of 2,400 per month. And this, when you now compute it on an annual basis, you realize it comes to around 28,800 per annum. So this is a relief that is only granted to resident taxpayers. So those non-residents that come and work here will not be subject to this relief. So it's the government demanding on one hand, but then saying that let's give you a small relief of like 2,000 so that at least your pay-as-you-earn reduces a bit. Yeah, but of course we have always been of the opinion that given the recent economic times, this relief should have been increased significantly, not with this 2,400, because the 2,400 is no longer really, it doesn't make a lot of economic impact on most employees. And of course we wait and see whether the government will revise this to a substantial amount. So what are the obligations under pay-as-you-earn? The first obligation is that you need to voluntarily disclose all your income earned by employees. Remember we said PS1 is an employer's obligation. So if you are running a business or you are working in the finance department for any business or any company, then it's your obligation to ensure that any income that you're paying to employees is actually subjected to PS1, and that PS1 is remitted to KRA. Then you also have a duty or an obligation to ensure that proper records are maintained, and this is for tax purposes and any other purpose. So you're supposed to ensure that records can actually be accessed. And remember the way we said, mostly we advise clients to retain documents for a period of, let's say, at least 5 years. But if you're able to retain for longer, the better, because you never know what will happen in the future. And the taxman or any other entity might want to look at or peruse your records for a couple of years. Then you're also under an obligation to ensure timely filing and payment of these taxes. So we said the deadline is 9th of every month. So it's good that you ensure that you file this on time and also make the payment on time before 9th. If we can look at the next direct tax, which is the income tax, or what we like to call corporate tax, we're going to look at what is it about, yeah, and who is liable for this. And you're saying this is a form of income tax, mostly levied on profit-making entities, including limited companies, some trusts, cooperatives, and any other entity that is in the profit-making business. So it's a form of income tax. So when you make income that is chargeable to tax, then you need to comply with corporate tax regulations and remit that. Then in terms of the rate that is applicable, the rate that has always been there is 30%. For resident companies. However, we've been seeing companies which are not registered locally, then the rate is usually a bit high at 37.5, which is chargeable on an annual basis. So it's always a good idea, even if you are a foreigner, it's a good idea that you ensure that you have locally registered the entity so that you can pay tax at a lower rate of 30%, unlike where you are a non-resident, ensuring that, or rather, when you're a non-resident, which you will be required to pay that 7.5 on an annual basis. If we can continue with corporate tax, so some of these expenses mostly is maintenance costs, insurance, finance, staff-related, capital allowances, etc. So all these expenses will be tax deductible and will be deducted. When you're now computing your annual income tax, then you'll have to deduct that in your tax computation and only now charge taxes on the net. However, we have some expenses which are also not allowable. Mostly we have depreciation. For depreciation, we normally replace it with what we call wear and tear, because depreciation, anybody can decide what will be the rate of depreciation. But now the government has sort of streamlined and said that if you want to claim depreciation, number one, you have to call it wear and tear, and the rates for that wear and tear has been well defined in the Income Tax Act, such that if it's a laptop, like the one that I'm using today, then the rate is already predetermined, because there are people who will say, for our laptops, we normally use them only 2 years, so meaning the depreciation is maybe 50%. But the government is probably saying, no, that cannot be the case, it has to be 25%. Yeah? So in that case, depreciation becomes a disallowable expenditure for tax purposes. Then we have personal expenditures by directors, also not tax deductible. We have fines and penalties. Recently, we also have subscriptions to member clubs and trade associations. So these ones have also been recently scrapped from tax allowable expenses. And then lastly, we have donations to unregistered charity groups. So these are just examples. We could have more expenses which are not tax deductible, but it's good that you know that the core principle that we look at is whether those expenses were wholly and exclusively incurred in generation of that particular income. Let's look at other income taxes. We can start with capital gains tax, or rather what we call CGT. So CGT is a type of tax, as the word says, that is applicable on any capital gains made, especially on immovable property. So this mostly applies to land, buildings, as well as shares that are not listed in the Nairobi Stock Exchange. So this is the CGT. It used to be there a long time ago, but it was abolished in 1985. However, during the Finance Act of 2014, we saw the government attempt to bring it back to ensure that any person who now sells a parcel of land or sells shares or buildings, and they have accumulated quite a bit of capital gains. Yeah, maybe you had bought that land for 10 million, you're now selling it for 200 million. That profit, that gain that you made is what the government now said they want 5% of it. Yeah, so it's a form of income tax, and we normally say is also a final tax. So once you pay that, you'll not be required to pay any further taxation based on the capital gains. The other income tax that we need to discuss is what we call the residential rental income tax. So basically, as the word says, it's applicable on residential rental income earned by landlords. And of course, we've been saying that effective the year 2020, or 2021, sorry, the rate has now been increased, or rather the threshold has been increased from 10 million per annum to 15 million per annum. So anybody who earns rental income or residential rental income that is below 15 million per annum needs to be paying this residential rental income tax at the rate of 10% based on the rent that you have received every single month. So it's also taxable on a monthly basis, or the tax period. Remember, we defined the word tax period. The tax period for this is also monthly, and is normally due by the 20th of the following month. So the tax never used to be there, but it was introduced by the Finance Act of 2015, and it became effective from 1st January 2016. However, at the point or at the time when the tax became effective, the government also said that if you believe as a landlord that this tax will be unfair to you, you could apply to the commissioner and tell them that you want to remain under the old regime. Remember, the old regime is whereby you do your books annually, you deduct all your expenses, and then you pay 30%. So mostly for people who had mortgages, who have taken mortgages to construct residential properties, most of them really rushed to the commissioner, because if your expenses are many and you only have a small profit on the rental income, then this 10% was a bit punitive. And that's why they were saying that you apply, demonstrate why you want to remain under the old regime. And of course, we saw a lot of people retained under that. But of course, anybody else was required to adhere to the 10%. The other form of income tax is what we are calling the turnover tax. So turnover tax has always been there, and sometimes it has been there, it has been abolished. So we've been having a lot of changes in turnover tax. However, effective January 2021, this turnover tax also became effective, and it targeted businesses that have revenues of 1 million Kenya shillings, and with that goes all the way to 50 million Kenya shillings. So in other words, they are saying anybody falling between 1 million and 50 million, they need now to adhere to turnover tax and pay this at the rate of 1%. So it's a replacement for corporate tax, because I know most people, most people are in the regime whereby you do your revenues, you do your books, you compute your expenses, and you pay 30% of your profit. But now this turnover tax came to at least the people who have these turnovers, the turnovers between 1 million and 50 million, are required that you should no longer do corporate tax, but you need now to be computing 1% of your revenues and pay that every single month. Yeah. So under this regime, your expenses are not tax deductible. It does not matter whether you are making a profit or a loss. Yeah. So it's for you now to estimate, or rather to be able now to compute 1% of your monthly revenue and remit that to taxes. Remember, we also had some suggestion, or rather some tax provision that had also been introduced, which they were calling the minimum tax. And the minimum tax was almost applying the same principle, because it was at the rate of 1%. However, those provisions were also put aside by the High Court, and the case is still progressing. Whether the High Court will say it was a rightful tax and it should continue, or it should be abolished, it's just a matter of wait and see. But we are monitoring that situation closely, and once there's a determination on that, we'll be sure to communicate to all our clients and all our potential clients. So it's good for you to understand that this tax is also final, in that once you pay 1% and you are falling under this revenue category, then you will not be required to pay any other taxation. Yeah, so it's just final. You pay 1% and you forget. However, it's important that you understand, if your income is above 5 million in a year, then further to this turnover tax, will also be required to do VAT, which, remember we said VAT is a form of indirect tax. So initially when this tax was there, the turnover tax, it used to apply to people below 5 million in terms of turnover. And most of the time that was looked at, maybe the turnover tax, it's like it was being seen as an alternative to VAT, yeah? Because that time it used to apply to people who were 5 million and below, yeah? And coincidentally, for VAT purposes, you have to be 5 million and above, yeah? So, but for the new threshold, of course, if you're still between 1 million and below 5 million, you'll not be required to do VAT. But if you do 5 million turnover every single year and above, then you'll be required to adhere to VAT regulations. That is in addition to turnover tax regulations. So of course we have certain exemptions. The way I say it, people below 1 billion are exempted, and also people above 50 million in a year are also exempt from this. And then we also have certain incomes being exempted from turnover tax, and these includes employment income, rental income, management fees, professional fees, training fees, as well as income subject to withholding tax, income subject to capital gains tax. I think we've just discussed the capital gains tax, and any other income that is actually exempt under the income tax. So if you are a lawyer or you are an accountant like me, or you offer training services, then you cannot pay turnover tax. You will still be required to do your books and remit 30% based on your profit. Let's look at another form of direct tax, which we are calling withholding tax. And this withholding tax, we normally say it's a form of an agency, or either is a form of tax that is deducted on an agency basis, because it requires you as a taxpayer, when you're making payments to certain institutions, to certain individuals, and the income is above a certain threshold, you need to withhold that tax and remit to KRA. In other words, you are like assisting the government to collect taxes, yeah, because it's not really tax that you pay out of your money, but it's out of the money that you are paying to your suppliers. Let's say your auditors, your lawyers, your contractors. You are under a duty to deduct that and remit to KRA. So that's why we say it's a form of agency, or rather it's a form of tax on agency basis, because the person who is deducting does not necessarily carry the burden of that tax. You're only doing it on behalf of someone else. Yeah. So of course, the only time you're exempted is if the organization that is receiving the money is actually tax exempt. So if somebody is tax exempt and they have an exemption certificate, then you cannot purport to deduct withholding tax from them. Let's look at some of the incomes that are subject to withholding tax. I think we said management fees and professional fees, as well as training. We also have dividends. When you distribute dividends to your shareholders, then withholding tax is applicable. If you pay contractual fees, maybe you have entered into a contractual arrangement with a civil engineer, whereby he's constructing an office block for you or a house or something, and you have a contract, then you are under a duty to withhold 3% of that. Then we have things like royalties, or what we call licenses. They're also subject to withholding tax. And lastly, we have interest. But for interest, the interest that you pay to the bank is explicitly exempt from withholding tax. I know some people can be tempted to tell their financial institutions that yes, you gave us a loan, but now we are going to withhold on the interest. So financial institutions have explicitly been exempted from this, but it only applies to loans that you obtain from friends or from other related entities or these other companies that are not financial institutions or duly recognized financial institutions under the Income Tax Act. We can briefly look at the withholding tax rates. For management or professional fees, residents are deducted at 5%, but companies that are not residents or the individuals who are non-residents, the rate is a bit higher at 20%. Then for contractual fees, it's 3% for residents. For non-residents, it's 20%. So the Chinese that you're seeing doing a lot of major construction projects, if they're doing it using the foreign company, then 20% of the payment is retained as withholding tax. Then we have royalties or licenses, again 5% for residents, 20% for non-residents. General interest, 15% for the parties, whether resident or non-residents. Interest earned from a bearer bond, 10% for each. Dividends, if qualifying, 5% to non-residents, 15%. Then commissions, 5% to brokers and 10% to others. Commission paid to ticketing agents, 5%. So basically these are the rates. Of course, there are other categories of services that are subject to withholding tax, but for now, I think this is what is relevant to this particular discussion. So if we can look at withholding tax on dividends, it is good for people to know that sometimes the definition of the word dividend can be very wide, in that it can be cash, it can be shares, it can be debentures, or it can be payments made to shareholders when the company is actually winding up. Yeah. So if a company is winding up and there is some distribution of dividends, then withholding tax will be applicable. And of course, there are different categories of dividends. We have dividends which are exempt. We also have dividends which we call they are non-qualifying. And basically this applies to those dividends paid by cooperative societies, and we have those that we call qualifying. And the word qualifying simply means that once the withholding tax is deducted, then it's going to be final tax. You will not be required to pay any additional tax on that. If we can go to indirect taxes, we said these are taxes collected by a person who does not really bear the ultimate economic burden. Or in other words, it's collected by an intermediary from a person who ultimately will bear the economic burden of that tax. And remember, we said a very good example of this is actually VAT. Because you as a business, you'll buy your things with VAT. You also sell, you'll do your markup and sell with VAT. But the person who will ultimately bear that burden of VAT is a final consumer. The person who consumes that particular product or service is the one who will bear the economic burden. So that's why we say it's indirect, because we have the person who is paying, especially to KRA, acting as if it's just an intermediary. You have picked from this person, you have retained your margins, and then you have paid to KRA. So as a business, you find that you become now an intermediary when it comes to these indirect taxes. So let's look at VAT first. And VAT, we are saying, is a general consumption tax that is borne on the final consumer, assessed on grounds, on goods and services, sorry. And we're saying the current regulations for VAT is actually the VAT Act of 2013. And of course, as we had said earlier, anybody who has a turnover of 5 million and above will be subject to VAT at the rate of 16% if they are dealing with standard rated goods. Of course, for purposes of filing, the due dates are 20th of each month. And of course, we're going to say that there are also various types on various rates of VAT. We have exemptions, VAT exempt goods and services. And under VAT exempt goods, we mostly have these fresh agricultural products. For instance, unprocessed milk. We have the vegetables that you will use every single day. We have raw meat that has not been processed. So all those are items which are actually exempt. And you'll notice even when you go to the supermarket, they will always be categorized as exempted from VAT. Then we have items which are zero rated, or rather the VAT rate is at 0%. And this mostly applies to exports, applies to supplies made to these export processing zones, as well as special economic zones. So of course, this is also another discussion, especially for EPZ and SEZ. So sometimes when you have a big project and you want to really optimize on your taxes, then you can always incorporate in the EPZ or the SEZ, because for instance, any goods that you buy, your suppliers will not charge you VAT. And even as you sell, you will also charge VAT at 0%. So it's a very lucrative sort of industry or sort of space to operate in due to those VAT 0% VAT rates. We can look at the standard rate, which we call 16%. This mostly applies now to everything else that has not been explicitly exempted or given the 0% rate. So any other item that you deal with that is not under the schedule for 0 rate or exempt rate, then you have to charge VAT at 16%. Remember, this had been reduced to 14% last year, but the rate was later increased to initial to 16%. Then we have other rated for VAT, mostly applying to fuel and petroleum, and at 8%. And of course, remember when this was introduced, there was a huge debate in that now if we are to apply VAT on fuel, what's going to be the cost of doing business? And of course, the initial proposals was that this was supposed to be 16% like any other item. But after a lot of outcry, the government resorted to cut this by half to 8%. So those are the VAT rates. This a very important point I would want to mention about VAT, which I know most of our taxpayers and also most clients sometimes always are not able to account for very well, which is VAT on imported services. And the whole concept about VAT on imported services is when you import services, when you recruit service providers outside the country, then you are required to charge yourself VAT on a reverse basis. If you get an engineer from the UK as a consultant and you're paying them for services that they're going to do for you, then you are under a duty to charge yourself VAT on reverse basis. We normally call it VAT on imported services. So most of the time you find that taxpayers don't know about this. So it's important when you are getting services out of the country, certainly those consultants or the service providers will not charge you VAT. They will not give you an invoice that has a local VAT. So as a taxpayer, you are required to account for the same. And we are saying some of the services that are subject to this include management services, professional services, training services, softwares and software licenses, software upgrades, web hosting services. Of course, some service providers will also give you access to databases, music, films, and games, and etc. So all these are services that's going to be subject to reverse VAT, and which you should now account it and pay yourself. Let's now look at another form of indirect tax, which is excess tax. And we are saying it's applicable on goods and services which are specifically under the 5th schedule of the excess duty. And of course, the whole idea about excess tax was to try and sort of discourage consumption of certain items or certain goods. Initially, we used to call it a sin tax because most of those products were being deemed to be sins, and the government was trying to discourage the consumption of the same by imposing excess duty. However, I think that is no longer the case because we have seen excess duty now being imposed on things like water, juices, and the like. So it's no longer a sin tax, but also a form of raising revenue. So the goods that are subject to excess tax, as I said, we have beverages, that is mineral water, juices, and soft drinks. We have alcoholic drinks, including beers and all that. We have cosmetics and also the products that ladies use for their hair. We have mobile cellular phone services by telecommunication service providers. We have fees charged by financial institutions, including withdrawal charges, money transfers, and the like. So all these are services that are subject to excise duty, and the rate is usually 20% for the same. Of course, other fees, including check commissions, service fees, are all subject to excise duty. But of course, we have certain restrictions, or rather some certain exemptions, mostly on insurance premiums and premium-based or related commissions. So these are the items that are exempted from excise duty. Of course, initially, I know most of you have been getting SMSs from your banks saying that now certain items will now be subject to excise duty because the products or commissions that were initially related to loans had been explicitly exempted from excise duty, but under the Finance Act of 2021, the government has now reverted and said that any commission being charged to you or any fee, even if it's related to a loan, then the same shall be subject to excise duty. So I'm pretty sure most of you have been getting those messages from different banks saying that effective 1st July 2021, then any charge by the bank will actually be subject to excise duty. As we finish, let's talk about custom duty. And custom duty is a tax, or rather it's a fine, or it's sort of a duty that is imposed on imports. And of course, we have some countries, very few countries, which also charge custom duty on exports. So it's really a tax that is imposed when you make imports or when you export by certain countries. Luckily for Kenya, most of the items that we export are actually exempted from custom duty, but of course we have also certain items, like for instance, if you export gold, you'll find that there's a 5% duty that you need to pay on that, but most of the items, they're actually not subject to customs when you export, but when you import, and of course you know that Kenya is mostly importing, you have to pay customs duty. And of course, the law that regulates this is what we call the East African Customs Management Act. And the reason we talk of East African Customs Management Act is because the East African countries thought it was a good idea to have standardized customs regulations across the region. So they sort of tried to enact one piece of legislation which was standardized in most of the East African country, and the provisions were also similar. So most of the goods that are subject to customs tax include machinery, vehicles, we have iron sheets, we have textiles, we have electronics. Any item that you can think of is usually subject to the customs tax. And of course, the most common rate is 25%. But of course, the idea has always been that if you're importing finished goods, then the rate be 25%. If you're importing, let's say, raw materials or semi-finished goods, then the rate is a bit 10%. And if you're importing machinery, especially things that now aid production, then the idea was to exempt. So you find that some of these machines have actually been exempted from excise duty. And of course, you know, like any other tax, as we saw in the Tax Procedures Act, if you don't pay on time, there will be an interest of 1% and a penalty of 5% on the principal tax. So for customs purposes, I know some of you have undergone what we call a post-clearance audit, whereby the government wants again to see when you imported and when you declared your taxes, did you really consider all the metrics? Did you adhere to all the regulations in terms of your declarations? And that's why it's important for you to keep certain records or certain documentation to really prove or to document how you did your transactions. And the most important are the import entry form. You must also be able to show your supply invoice for purposes of valuation. Remember, if we are saying certain items are subject to 25%, then the basis is usually your supply invoice, unless there's some variation in terms of the value. Then you must also keep evidence of your payment slips so that now you demonstrate that you indeed pay the taxes. You must also keep the bank payment slips as well. The bill of lading, also very important. The IDF form, you must also show a certificate of origin to show now from which country did you get those items or goods. Then lastly, and also very important, is the inspection certificate, so that those goods, if those goods are subject to inspection, then you must be able now to show that they were duly inspected and they conformed to the local regulations in terms of quality, in terms of any other metric that the government has put in place. So for compliance considerations, as we finish, there are key areas that you're supposed to consider, but what we always say is the most important is the aspect of keeping records, because in all the jurisdictions around the world, if you're not able to document and show how you did your transactions, especially the historical transactions, then the taxman can always use their discretion to conduct audits and also to raise additional assessments. So that's why we always say that the single most important thing you can do in terms of tax management is to ensure that you have fully kept your documents and you're able now to really demonstrate how you did your transactions for at least for the last 5 years, as we had mentioned. So you are required, if you're able to keep the records for longer, I think it's also very much advisable, because as we said, sometimes even though the compliance audit is limited to 5 years, KRA might come and say, look, we think you have been evading taxes and we want to look at the last 10 years, for instance. So you must be in a position to really demonstrate that at least you had some records and you really do not engage in tax evasion. Then secondly is the issue of paying taxes. Of course, it goes without saying that it's good to honor your tax obligations. It's good also to do so on time so that you avoid a lot of issues and a lot of disputes with the Revenue Authority. And if in an instance where you have a tax dispute, it's always advisable that that particular part of the tax that you've not disputed, you ensure that it is fully paid, or you have made arrangements to pay the same, so that you avoid a lot of disputes with KRA.